I love the line. You were talking yesterday, and you just dropped the line, land of confusion. This tug of war that's kind of going on between labor markets and the data from labor markets and the inflationary data, and how there just is kind of some tension or tugging back and forth going on there. So,
well, we've had just this move in yields has continued into the new year, right? And we started the year at 457. It went all the way through. I think last time we were here, we were basically 475. It touched 480, 481. And that came off the heels of a really hot jobs report that, in early January, 256,000 new jobs added on 153,000 consensus. So the labor market's tight. We're down to 4.1% unemployment from 4.2. Not sure how much of that is seasonal because that's December's number, but that was, there was a lot of that was baked in. How much of it is, again, sort of this Trump effect that no one's really sure about yet. But subsequent to that, we had some pretty good inflationary numbers that cooled the yields down a little bit, right? We had PPI come in last week. Core PPI month over month came in at zero month over month. And we had some hot PPI numbers in November. So I was expecting, typically because PPI front runs CPI by about 3 months, I was expecting a hotter than average CPI number this month, even with a cooler PPI number. But then the CPI number came in 0.2 month over month core on a 0.2 month over month consensus. So again, you're talking about 2.4, 2.5% annualized with that number. Still not at the Fed's preferred target of 2, but that's CPI. I'll be curious to see what happens with PCE next week. My guess is it'll probably come in 0.1, 0.2. And that's the preferred gauge for the Fed because they don't use imputed prices with PCE. It's just how money is actually spent, which is a little different. So that gets us back to this sort of land of confusion is where does that, with a 10-year sitting at, basically 460, 470 and a policy rate at 4.5, where do we see the multiple going? Okay. Right now we're at 22.2 times earnings right here as we sit here today. So how much room do we have for multiple expansion? I don't really see much. We're already pricing in about a 14.5% earnings growth rate this year. Okay, so a 22 plus multiple on a 14.5% earnings growth is pretty strong. Okay, it's fair. Don't get me wrong. It's nothing wrong with it. It's fair. If we had a 19 times earnings, I would say, well, a 14.5% growth rate is a pretty good deal, or 19 times multiple is a pretty good deal at almost a 15% growth rate, right? But that's a fair relationship. The kicker here is what's the risk-free rate, right? Because the earnings yield on the 10-year Treasury note is basically sitting at 22, right? The earnings yield on the S&P is sitting at 22. So we have parity now between earnings yield on bonds, basically, and earnings yield on the market. But of course, there's tremendous more volatility in the markets, and that's the risk that you take. So what will move the markets up from here if it's not going to be multiple expansion? Because we don't, like we talked about before, we don't necessarily see a massive contraction of interest rates this year. I think there will probably be a general range that the 10-year floats in, 3.5 on the lower end, maybe 5 on the upper end, 4.75 to 5 on the upper end, and we're closer to the upper end. But with obviously the Trump honeymoon is still in effect, and his inauguration happened since the last time we talked, and he was very pro-business with all of his speeches. And yesterday in Davos, he doubled down on do business in America, do business in America, do business in America. And I want my company, I want American companies to be able to do business internationally without the threat of tariffs. And and these fines that are being levied by these European countries on our big blue chip companies, our Metas, our Googles, our Microsofts, our Apples, right? It's just a form of taxation. Okay. And he's not wrong. They are. That's what they're trying to do. So they tariff the products coming in, and then they basically generate some regulation that they know they're going to be in violation of, and then fine them for it. Right. That's what he's coming up against. So not to get too much into that, but the general narrative is there's going to be a lot of free trade taking place. What the final version of that is, I don't think anyone really knows yet. Okay. But there's going to be more free trade. There's going to be more American products on international shelves at a lower price point, probably very soon. So, I think the market has some of that priced in, being that we're 22 plus multiple, being that we have a 14.5% earnings growth rate kicked off after we've had, 2 20 plus years in a row. I think there's going to be, but what could sort of throw a monkey wrench in the whole works is, Trump himself, and not to get too political here again, but Trump said the world needs to lower interest rates. Well, that could be a problem now. If you're talking about a very pro-business president like he is, a very pro-free trade president like he is, in a very pre-trade global environment that we're going into, and you have cheap money to do it, that is a recipe for inflation to just take right back off. You know what I mean? Everyone can get everything they want. The demand curve will absolutely go parabolic, okay? And that's not going to be good for inflation. So I think the Fed knows that. And of course, I am a fan of the separation between monetary and fiscal policy and the Fed staying independent. And I think that needs to take place. So, and I think it will. And I think the Fed knows that. And I think it's more political bluster than anything else. But as long as they're holding monetary policy, and back to, the rate cuts for this year, rate cuts because of the CPI and the PPI numbers. Last time we talked, I think we were like a 1 rate cut priced in for the year based on the chart of CME. It's now up to 1.6 because of those numbers. And I'm going to still hold sort of this 3 plus 1 minus 1, so that 2 to 4 range. I think is where we're likely going to end up, because shelter came in 0.3 month over month in the last one, and last year those were coming in at 0.6 and 0.45. So the year over year number on shelter should really start to go down. And I think that's really going to cause those CPI, PCE, and PPI numbers to really start to drop. And I think that will be a good tailwind for policy rate, good tailwind for the shorter end of the curve, right? But I think that middle and longer end, that 10, 15, 20, 30-year end of the curve, I think is going to stay. I think it's going to hold. I think, like I said, I think the bottom end of the 10-year is 350. But I really don't see the 30-year getting below 4. Okay. So again, it's going to be at what point of the yield curve do you want to start picking and choosing? So that's kind of what we're thinking so far.
As always, the Intelligent Investment Show is for your entertainment, education, and general amusement purposes only. It is not intended to be financial advice or investment advice of any kind. Neither Matt nor I or any of our companies or associated entities know anything about your financial circumstances, so it would be unwise for us to tell you what to do with your money. We encourage you to seek a professional if you do have questions about your portfolio or your financial plans. If you would like to reach Matt and his team, you may do so by giving him a call at 702-655-8300 or visiting intelligentinvestment.com. We thank you for joining us. We'll see you next time.